What's up, traders? Anthony Crudele here, and thank you for tuning in to the Futures Radio Show podcast. In today's episode, we're exploring the current economic landscape with Erik Norland. Erik is the chief economist at CME Group. We'll discuss what's happening in the economy versus what the markets are signaling. Erik will shed light on the primary drivers of the stock market, the sustainability of current growth, and how market sentiments align with economic data. We'll also examine sector performance, the influence of Fed policy on market performance, and market expectations within an election year. Erik will provide key takeaways that every trader and investor will want to know as we move into the second half of the year. Let's get started. Today's podcast is brought to you by CME Group. Whatever the obstacles, CME Group provides the tools that global market participants need to manage risk and capture opportunities. With 24-hour access to futures, options, cash, and OTC products across all major asset classes, you can drive your trading strategy forward with confidence and precision. CME Group, where risk meets opportunity. Erik, welcome back to the show, my friend.
Thank you for having me.
Great to catch up with you. It's halfway through the year, new quarter start today. Markets are off to a pretty decent start. Crude oil is off to the biggest start, I think, of all the markets that I've been following. What's catching your eye so far on the first day of the quarter?
Well, crude oil is always interesting, but it's been trading in this range now for 2 years. We're kind of moving from the lower end back towards the middle to upper end of the range. But, aside from that, what really strikes me today is the steep sell-off we're seeing in the long end of the bond curve. We're seeing really steep sell-off in 10-year, 30-year bonds. Potentially a lot of supply coming onto the market with the huge budget deficits, not just in the U.S., but in many, many other countries. Very, very generous supply and continued decent economic data that would kind of call into question whether or not the Fed needs to ease quickly.
Well, let's talk about that then, because we're at this point in the market where I think that a lot of people are uncertain really what the driver is of the market right now. What is the primary driver of the stock market now? I've done a lot of podcasts where people are telling me now that what the Fed does between now and the end of the year or even early into next year is not that big of a deal. It's not that going to be that important. It's not going to be the focus. Right now, the focus is earnings projections. Markets are really focused on earnings, which is really interesting because we've been so focused on the Fed, Erik, for so long. What do you think is the primary driver of the stock market right now?
Well, I think the main thing that really strikes me about the stock market is the tremendous divergence we're seeing within the stock market itself. If you look at the stock market's internal correlation, so the correlation of one stock versus another stock, the correlation of one sector in the market versus another sector in the market, those correlations have all collapsed. And so what's going on now that's super interesting is individual stocks and individual sectors are actually very, very volatile. But their volatile moves are offsetting one another. So the indices themselves on a day-to-day basis are moving at a snail's pace. So you're seeing really, really low costs for options on the S&P 500, on the NASDAQ 100, implied volatility at really low levels. And you're seeing the exact opposite in the market for individual stocks and for sectors where volatility is actually rather high. So we actually have the biggest gap between the volatility of individual names, which is very high, and the volatility of the main indices, which is very low.
I see a lot of these divergences you're talking about. I mean, NVIDIA was the name. Now you're seeing Tesla get bumped up. You're seeing Amazon go on a run. I see that in the individual names, but in the indexes, the real divergence that I have been wondering if it's ever going to catch on is the Russell 2000 catching up with the S&P and NASDAQ, right? We've talked about on this show so much and how the Russell is tied to lower interest rates. It needs interest rates to come down to get going, right? We had the beginning of the year. I remember you and I were talking about 6 or 7 cuts. We said that's probably not right. You said it's more like 2 or 3. You were right about that. Here we are now. Maybe it's even 1. And even with the cuts still being in the picture, the Russell cannot hold any sort of rallies here. We just had Russell Recon. And even after that, I mean, just every rally just continues to being sold. What do you see in the marketplace telling you? What is the Russell 2000 telling us about the overall market?
So I think what the Russell 2000 is showing us is something we also see in certain parts of the economic data that have been coming out, especially the employment data. Since the Russell hit its record high in November 2021, which is amazing. So Russell's not anywhere close to a record high. It's 15% down from its record high. The S&P and the NASDAQ since that time are up maybe 10 to 15%. The Russell's down 15%. And what's really curious to me is the Russell, of course, is an index of mid and smaller size stocks, much, much smaller than the companies in the S&P or the NASDAQ. And what we're seeing in the economic data that's kind of paralleling that is a huge gap between what economists call the establishment survey and the household survey for employment. And of course, we get new numbers out on Friday. So the establishment survey is what gives us non-farm payrolls, average hourly earnings, and a number of hours worked. That survey, which is primarily a survey of big businesses like those in the S&P and the NASDAQ, shows that the U.S. economy has gained 1 million jobs in the 6 months between the end of November and the end of May. By contrast, the household survey, which does a better job of measuring what's happening at small and medium-sized enterprises, shows that over those same 6 months, the U.S. lost 1 million jobs, which is why the U.S. unemployment rate has risen from 3.5% to 4%. So, one of these things is showing the labor market's in a downturn. The other one is showing it's still growing. And so what's the difference? Well, these big companies like the S&P, the companies in the S&P and the NASDAQ, they have been benefiting from higher interest rates for two reasons. First, many of them, including these tech companies you mentioned, some of them are sitting on tens of billions, even hundreds of billions of dollars of cash. That's earning 5% per year sitting in T-bills. And a lot of these companies either entirely equity finance or they borrowed from bondholders 3 or 4 years ago when yields were at very low levels. By contrast, small businesses, they don't issue bonds and they're typically not sitting on large piles of cash. So they're very, very negatively impacted by higher rates. So it looks like not only is the Russell suffering, it looks like small businesses are laying off staff in very, very large numbers. And this has sort of been largely overlooked in our discussions of what's going on with the labor market.
So what fixes this divergence? What is something that we as traders should be looking for to say, okay, the Russell 2000 now should start to play catch up, or we see the divergence switch where maybe the Russell gains strength and tech starts to get weak, because you never know, that rotation could easily happen as well. What in the data should we be watching that tells us that the Russell is now potentially have the ability to play catch up?
So I think there's a couple things. So one is the forward interest rate curve. The forward interest rate curve is the expectations that people have for what's going to happen to rates. So recently, as you alluded to at the beginning of the program, we've gone from expecting 5 or 6 rate cuts to expecting maybe 1 or 2, possibly 3 rate cuts. That's been really, really difficult for small cap stocks. If that moves in the opposite direction, if the market comes to expect deeper, faster rate cuts from the Federal Reserve, which could easily happen, because you have to remember these interest rate expectations are very volatile. If they start moving back in the other direction, that could be really bullish for small cap stocks. Also, if we see economic data that would suggest that the U.S. economy perhaps is going into some sort of an economic downturn. And look, last month we had weak consumer spending. We have a new employment report coming out on Friday, July 5th. If any of this data turns out to be weak, it is signaling a downturn that might speed expectations of the Fed cutting rates and could potentially benefit small cap stocks, at least relative to larger companies.
So do you think that right now the markets are overly optimistic?
I think that the markets have been focusing almost entirely on the strong aspects of economic data, and they've been overlooking a lot of other pieces of economic data that are released in parallel that tell a different story about the U.S. economy, that show a U.S. economy in which many smaller and mid-sized enterprises are struggling, consumer spending is slowing, business confidence is not particularly strong. It's not terrible, but it's not strengthening, maybe even softening a bit. If you look, for example, the ISM surveys, both the manufacturing and non-manufacturing, they've been showing that employers intend to probably lay off more employees over the next 6 months than to hire. So I think there's a lot of sort of soft indicators out there that the US economy is downshifting to a much, much slower pace of growth. And I think that's been really overlooked, particularly in the bond market, including today where we're seeing another big sell-off.
I want to talk about how you assess the current state of consumer spending in the US and what implications do you think it has for the overall economic health and inflationary pressures?
So look, in March 2020, we approved a $3 trillion piece of COVID relief. That was followed by 900 billion more in December 2020 and another 2 trillion in early 2021. That $5 trillion or so of COVID spending, or $6 trillion almost, basically put consumer spending on a rocket launcher and send it into outer space. So consumer spending rose tremendously over those few years. What's happened since about the middle of 2021 is consumer spending has started to flatline. So consumer spending is actually still rising, but it's only rising at the pace of inflation. So consumers are spending more and more money, but they're buying basically the same amount of goods. And in the first several months of this year, including in the month of May, we had a lot of disappointing consumer spending numbers. So consumers seem to have gone through a lot of the surge in savings that they experienced during the pandemic. Their savings rates have dropped down to much lower levels. Consumers are also starting to be hit by much larger interest bills, which is why we're seeing soaring default rates on credit card loans and auto loans in particular. And so all of this, I think, is indicating sort of a squeeze in consumer spending. It's sort of indicating that we're moving towards a slower pace of economic growth. And for whatever reason, the markets don't really seem to be paying much attention to that outside of small cap stocks, which seem to be in tune with what's going on.
Yeah, exactly. So, how do you think current market sentiments compare to the actual economic data that we're getting?
Well, yeah, I think it really depends how broadly you define the market. If you look at the Russell 2000, for example, again, down 15% from its record high. If you look at the equal weighted S&P, for example, it's actually above its 2021 record high, but it's below what you would have earned on T-bills. So if you had just invested in T-bills 2.5 years ago, you'd be up 10%. In the equal weighted S&P, you'd be only up 6% or so. So it's really this sort of interest among investors in a small group of stocks, a Magnificent Seven or Magnificent Eight or whatever they are, that's driven the big indices like the S&P and the NASDAQ to recent record highs.
Yeah, we talked about the divergence and really that rotation. I want to get into more of what's happening within the S&P 500 because when we talk about sector performance, we're seeing these rotations, which I think overall is bullish because on days where you see some of the tech lagging or even the days that the tech is strong, you're starting to see all these other sectors within the S&P performing well. Which sectors coming into Q3 already, Erik, do you see being maybe the outperformers or maybe more of where the market puts its focus and maybe some sectors where you think start to lag?
Well, I think it's a really difficult question to answer. I mean, some of the sectors like the energy sector and materials depend really on energy and metals prices. Other ones I would say are fairly recession resistant or interesting, like consumer staple stocks have not been particularly interesting these last few years. But if we were to go down towards a slower pace of economic growth or even a downturn, consumer staples could wind up being big outperformers. That might come at the expense, for example, of consumer discretionary stocks. Consumer discretionary stocks have been sort of in second place after tech as market leaders over the last few years. They might be vulnerable to a downturn. I don't know. There's a lot of different possibilities there. Health stocks tend to be pretty stable. Utility stocks are very interest sensitive. So if we were to see deeper than expected interest rate cuts sometime later this year or next year, utility stocks could be big outperformers along with the Russell, for example.
Yeah, and we talk about those utility stocks. I mean, if tech continues to go where it's gone, the utilities continue to perform because people talk about how much power is going to be used from AI. I don't know if maybe you want to touch base on that a little bit, how utilities actually been being driven a lot by what's happening in tech.
Yeah, I mean, so there's tremendous demand for data centers around the country and around the world. Look, I was at an investment conference with one of the major European investment banks. And so they had launched their own internal AI system. And apparently it required as much electricity as a small town. Energy demands of AI is really, really off the charts. So it's creating a lot of electrical demand that could also potentially play out through the copper market as well. Copper's been unusually strong, which isn't true, by the way, for any of the other industrial metals. Aluminum, iron ore, steel prices, all very, very low. Copper prices was clearly off their record highs from a few weeks ago, but still very, very strong compared to the rest of the metals complex. But yeah, that could also play out through the utility sector as well.
Yeah, and leading into back to energy, because first day of the quarter today, as we're recording here on July 1st, you see crude oil off to a really strong start. I mean, that market's been quiet, but let's face it, if utilities are going higher and the world needs more energy, you would make the assumption that at some point that's going to trigger something in the energy markets to get going. And crude oil showing us that at the beginning of Q1. When you look at the data, the actual fundamentals of crude oil, how does it look?
So to me, crude oil is one of the most remarkable traded instruments on the planet. So if you consider that in the last 2 years, OPEC has cut production by 3.6 million barrels per day and kept that production low, that a war broke out between Russia and Ukraine, it is ongoing, and that the Houthi rebels in Yemen managed to reduce shipping traffic through the Suez Canal by roughly 80%. The fact that crude oil prices are about the same level today as they were 2 summers ago and way below their peak in, say, late May, early April 2022 is truly remarkable. And it reflects a couple of things. So first of all, U.S. production has increased a bit. It's replaced about a third of what OPEC has cut. So we've gone from 12 million to a little bit over 13 million barrels per day here in the U.S. In addition to that, Chinese demand has been really weak. China's economy is growing at a snail's pace. China is the world's biggest importer of crude oil. They import around 10 million barrels per day. Their demand for oil has now been falling for 2 consecutive years. And in China, last year, 35% of the new cars were EVs, which creates a lot of electrical demand, but reduces demand for crude oil. And EVs are also picking up here in the United States with the Inflation Reduction Act and all of the investment in recharging stations, et cetera. And just generally speaking, the world's vehicle fleet is becoming more and more efficient. On a year-on-year basis, the average car uses 2% less fuel than it did the year before, because we're replacing cars that are on average about 12 years old with new cars that use about a quarter less fuel than the ones they're replacing. So the crude oil market has a lot of headwinds. And so it seems like these forces that are governing crude oil, OPEC, geopolitical conflict pulling prices up versus the economic fundamentals and technological fundamentals that are pushing prices down, have been in roughly even balance. And that's kept the price stable now for 2 years.
Yeah, and when you think about it, you noticed how Tesla, Rivian, they've had some moves lately. Crude oil going higher, I think, is good for those stocks because people start looking at Teslas again. People start looking at Rivians again. Because the electric car market has been dead. But once again, that really brings a spark to the S&P and Nasdaq when Tesla gets going. That's that oldie but a goodie. And when that market gets going, I think that it just, because it's been so weak, I think it drives confidence back into the marketplace. Go back to these rotations. We just continue to see it. I want to talk about interest rates a little bit. I mentioned that a lot of the macro people I have on this podcast lately have really been discussing that the Fed is no longer the focus. I've already mentioned that. They're saying if they cut once or twice in the next 3 to 6 months, it doesn't really change much of anything. What is your outlook for interest rates for the remainder of this year?
So I think that the Fed is going to have trouble cutting interest rates at the next two meetings. I wouldn't say it's impossible, but they started meeting late July. Unless we get really weak economic data, which is possible, the Fed might not want to cut. Now, if we get a really weak employment report, if the inflation numbers and consumer spending numbers continue to come down, it's possible we could get a Fed cut at the end of July. The September meeting is tricky because it's in the heart of the election campaign. The Fed probably doesn't want to be seen as moving policy unless it really has to and has no other choice. So that kind of leaves the next meeting on November 7, which is 2 days after the elections here in the U.S., is sort of their next real option to move policy if they don't do it in July or September. My view of the Fed sort of more generally is the Fed tends to keep interest rates low for too long and then panics and raises them. And then they tend to keep rates high for too long and then panics and cuts them. So my guess would be the Fed stays higher for longer, but then cuts way, way more than the forward curve currently suggests. The forward curve currently says the Fed eventually brings rates down to 4%. I wouldn't be surprised if eventually, if we have a recession next year, they go to 3, 2, maybe even 1% rates, in which case, and again, this is not a forecast, it's a possibility for what could potentially happen. And if that were to happen, you would have a potentially huge steepening of the yield curve, potentially a huge rally in precious metals, especially gold, but maybe silver as well. And then also potentially really big gains in small cap stocks relative to large caps.
Couple questions off of that. First off, do you believe that where we are right now with 5%, 5.25% rates, is that really too high?
Well, I think it may be too high. I mean, one indicator that it's too high is that the yield curve is really, really sharply inverted. Normally the yield curve has a positive slope. So normally short-term interest rates are lower than long-term interest rates. We've had the opposite of that now for the past 2 years. There's a lot of people who are saying, well, this time is different, because the inverted yield curve reflects lower inflation expectations, which could be true, could also reflect falling, inflation expectations. But generally speaking, when we've had yield curve inversions in the past, that has been followed by economic downturns with usually a lag of about 2 years. And that's the really tough part for the Fed, for investors, for economists. 2 years is a long time. So you could have an inverted yield curve for 2 years and the economy continues to grow. But it's only later on that the downturn hits. And what makes me really worried is when I look into the economic data, I look at things like the household survey, which shows rising unemployment, which shows we've lost 1 million jobs since late November. You look at weaker consumer spending. You look at some of these surveys like the ISM surveys, employment components, which show potential net job losses coming in the next few months. And I'm really concerned, the Fed may have over-tightened policy and may be keeping rates too high for too long. Now, that's not proof that things are going to go wrong. We'll have to wait and see, but that's my concern.
And going back to where you said the Fed will stay higher for too long, just like they stayed lower for too long. The question I have about this current market environment is that if they were to go back to cutting and taking us too low too quickly, wouldn't that create inflation again? Wouldn't we almost set that situation right back up to where we are now because rates were too low for too long? So I guess a lot of people that I talk with say that the Fed is most likely just to really do really little to nothing. But if what you're saying starts to happen, boy, that just gets really interesting, I guess, because I guess it would come down to the reason as to why they're cutting too, right, Erik?
Yeah, that's right. And so, that's why I really think it's unlikely that the Fed goes back to, say, zero rates. So if you look at the last couple of recessions, the one we had in 1990-91, the one in 2001, the one in the global financial crisis around 2008, and also the sort of artificially induced pandemic recession. Well, during the first 3 of those recessions, the Fed cut interest rates by 500 basis points or more. They obviously couldn't do that at the beginning of the pandemic because rates were only 2 3/8% to begin with. But they did cut rates down to zero the last 2 times. And the previous time during the tech wreck, they cut rates from 6.5% to 1%. I don't think they're likely to move policy that low because just for the reason you stated, inflation is not normalized all the way back to 2%. It's still running at 2.6% on the core PCE, still 3.5% on CPI. But I think that there would be potentially people who would look at that and say, well, you know what? The only inflation that we have that's running above average is rental costs for housing. If you exclude rental costs for housing, we're actually below 2% inflation. And so the Fed's interest rate policy doesn't really influence rental costs very much because rental costs are being driven by really low vacancy rates, which are in turn being driven by very, very low levels of construction, and construction itself is being impeded by high rates. So, I think that there is a case there that the Fed could ease policy, not as dramatically as it has during some of our recent recessions over the last, say, 30 or 40 years, but still cut rates more than what the forward curve currently suggests, which is really not very much.
So it's interesting what you just said about housing, and is that if the Fed were to start cutting rates, that would actually put builders out there, and then you would go from a supply and demand issue where there's rents are high because there's a lot of demand and there's little space, that if actually rates go lower, that ultimately is going to create more supply. And therefore, in this situation, typically we would think if rates are going lower, that people would flock into real estate. But I'm almost wondering if rates go down this time, that actually gets more people to sell and it creates more supply in the market. Builders get back to building. It actually takes housing prices down.
It's it's a really complicated equation because the housing market, in terms of people buying housing, that's really connected to long-term interest rates. So it's really driven by 30-year mortgage rates, 15-year mortgage rates, which are tied to U.S. Treasury yields. So I think the difficulty here is if the Fed eases policy and they steepen the yield curve, it doesn't necessarily lower mortgage rates very much, because the mortgage rates are connected to the long end of the curve, and the long end of the curve might not come down with short rates because federal deficits are so huge and the amount of bond issuance is so enormous. But what could happen if short-term interest rates come down, it might spur a lot of building activity, which was definitely the case when the Fed slashed interest rates in 2001 in particular. The Fed cut interest rates from 6.5 to about 175, and then later on lowered them down to 1%. And we saw this huge boom in the amount of housing construction in the US. It was initially met with strong demand, but eventually sort of overwhelmed the market by 2006, 2007. And we saw really sharp rises in vacancy rates. But at the moment, vacancy rates are ultra low. Housing construction activity is really slow, and the market to actually buy housing is really slow because mortgage rates are so high. And there's a lot of people who might like to move around, but they can't because they're stuck in a house and they're tied to their mortgage.
Yeah, that's going to be really interesting to see how that unfolds. I want to stay on bond market. A friend of mine who's on the show a lot, Bob Elliott, he put a tweet out the other day. It got a lot of people talking, and I want to get your take on it. So I'm going to read you the tweet. He said, "The stronger for longer outlook nailed the macro environment in the first half of 2024, but macro dynamics and market pricing have clearly shifted. Second half of 2024 will likely be dominated by disappointment from a growing but slowing economy." He went and did a whole thread on it, and I pulled this out from the thread. It said the trouble for many investors, particularly those in bonds, is that the growth slowing from where it has been to something closer to 1% to 2% is probably not slow enough to create a fast enough loosening of the labor market for the Fed to feel urgency to cut quickly. Just wanted to get your thoughts on that, because a lot of people on X were talking about this thread.
So I kind of agree with the general thrust of it, that certainly the first half of the year was dominated by higher for longer and by sort of decent economic data, but somewhat slowing. But again, there where I take issue is when you really look into the labor market data, it just depends what series you look at. The NFP numbers have been spectacular, showing 200,000 jobs gained per month, over 1 million jobs between the end of November and the end of May. If you look at the household survey, you see the exact opposite. So I really see two economies operating, sort of existing simultaneously next to one another. One is an economy of big business, which is prospering. Another is an economy of small businesses, which is really hurting and appears, according to this data, to be laying off staff in fairly large numbers. So I think that the evidence of a slowdown may be even stronger than what he's suggesting in his comments on X.
Yeah, I mean, great to hear your point of view, Eric. Like I said, that was kind of like the talk of the macro guys. And I'm like, I got Eric. I want to pick his brain about this stuff. I want to move on to a couple of things before we close out today. It's an election year. And from the perspective of an election year and typical seasonal trends, are the markets performing as expected? Are they not? Is there anything notable we should be looking for when it comes to a macro environment heading into an election year?
Well, many, many years ago, people used to talk about the political business cycle. So there was a tendency to have stronger growth in presidential election years and then recessions around the time of the midterm elections. The political business cycle really hasn't worked, though, in the last several decades. It really hasn't been much of a thing. We had consistent growth throughout Clinton. We did have a recession early in the second Bush administration, but then we had the global financial crisis during a presidential election year. We had pretty strong economic economic growth from 2010 up to 2020, when the pandemic struck. I don't really think the political business cycle is much of an issue, but we did publish a paper recently that looked at whether or not markets are more volatile in presidential election years. It turns out generally that's not true if you exclude 2008. 2008 was kind of a special exception because you had Bear Stearns collapsing that March, Lehman Brothers collapsing that September. You had the banking bailout in October 2008. So you had this huge rise in volatility. If you take out 2008, there's just really not a lot of trends around election years that make them look very exceptional. The one caveat, the one thing I would add though, is in the aftermath of a presidential election, in the days after the election, once the results become known, you can have massive sector rotations, which we had during the last two presidential elections. So I would look for a lot of sector-related volatility when it comes to November.
I agree with you. I mean, 2008 obviously was the one-off, was probably the busiest year of my trading career. There's not been another year quite like it. I mean, COVID was kind of close, but even that, those of you that traded the COVID year is nothing like 08. 08 was unbelievable. I agree with you. It's not leading up to the election, it's after the election, because, and this is one of the key things when you have futures markets like you guys do at CME Group, all of the commodities, what's going to happen in interest rates, a lot of that stuff coming from different possible policy changes or policies staying in place. That's when you start to get movement across the board, and when people start to think, what is the next president going to do? So I agree with you. I think it really comes after the election. I think it's going to be kind of business as usual for markets up to it. Like you said, it might be a little bit more volatile, but ultimately afterwards, it'll be interesting. Energy markets will be a place that I think is going to be very much a central focus following the election. In conclusion today, Erik, it was great to pick your brain on all these different topics, but I'm curious, what are some of your key takeaway for investors and traders as we move into the second half of the year?
So I think the key takeaway is that during the first half of the year, we saw this big backup in interest rate expectations, going from expecting the Fed to cut 5 or 6 times to maybe just 1 or 2 times. I would not be surprised if in the second half of the year that goes in reverse in a big way. I think the market has been overly focused on the strong aspects of data, and it's been sort of ignoring some of the weaker aspects of U.S. economic data. And I would think that the consequences of the 525 basis points of rate hikes that we had that ended almost a year ago at the end of July last year are going to start becoming more and more clearly into focus as we move into the second half of this year. You're going to start seeing higher default rates on all sorts of different kinds of debt. It's going to potentially widen out credit spreads, potentially slow hiring, and potentially create a shift in psychology where the markets move back to expecting lower short-term rates. And if that happens, that could be potentially very bullish for gold, for silver, and maybe also for those small cap stocks, at least on a relative basis compared to the large caps.
Yeah, I've been reading a lot more in depth on a lot of the macro traders that I follow about that exact thing, Erik, and I look forward to having you back on probably right around the election or post the election to see, if that stuff is starting to come into play. Like you said, it's going to be interesting. Erik, thank you so much for joining me today. I always learn something from you. It's always a pleasure to have you on the show. Tell anybody where they can go to read more about the papers that you're putting out at CME Group.
So our papers are all on cmegroup.com, and they can just go to our research section. The research is all there. It's all free. And we have a new economist, Mark Shore, who's just joined us today. And so he'll be adding to the quality and the quantity of that research over the next several months.
Oh, great team. You, Mark, Blue, great guys, great team, great insights. Erik, thank you again so much for coming on Futures Radio Show.
Thank you.